Now, here is my theory on life insurance. Well, first of all, let's just say again, most people are in the system designed for them to fail and they don't know it, right? Life insurance is no different. It's one of those businesses that falls into, that situation falls into. Here's my theory. Here's my background. Let me give you my background first, and then I'll give you my theory. I am with Primerica currently, right? I've not always been with Primerica. I started off with Prudential. I did some time with Liberty National. I was an independent for a while before I came to Primerica. And I've sold everything under the sun. Return to premium, variable, whole. I've made money doing all of that. All right. I am with Primerica currently. And I am under the impression that most people, I'm not naive to know that everybody, that this works for everybody, right? I'm not that naive, but I am under the impression, based on my experience, not just the fact that I'm with Primerica, right? But based on my experience, most people will benefit the most from a solid term policy and an investment on the side. A solid term policy. And it sounds just like what we say, buy term and invest the difference. And here's the reason why. I'll give you a couple stories. The first story I'll tell you is, my grandma, right? So my grandma passed away when I was 14 years old. I think my Uncle Willie Joe had some life insurance on her. We had enough money to pay for a funeral, pay for a police escort, and then we had a cookout. Y'all know how we do. We have a cookout, right? Fast forward, I'm in the office at Prudential. Don't know nothing much about anything, although they told me that you pass these tests, and then you come back and sit down with us. And so I passed the test, and I'm sitting at the table with all these old heads, and they passing out scenarios. Now, my experience with life insurance was with Grandma, about $15,000 in life insurance. And then in the Marine Corps, I had $100,000, then they went up to $400,000. Now I'm out of the Marine Corps, and I don't have anything. And they're throwing around scenarios, and one of the individuals at the table threw out this scenario. He said, hey, I got these two educators. They both have $250,000 in their retirement account. What do we do with it? And the first thing somebody hollers out is, we got to get a $500,000 life insurance policy. Now listen, I stopped breathing for about 1.2 seconds when I heard this. Because it never occurred to me on the outside of the military. And if you weren't a professional athlete, right? I know some athletes, they insure their legs and their butt and all that kind of stuff. So outside of those individuals, right? It never occurred to me that a regular person had $500,000 in life insurance. But what I learned from that agent who suggested that, after he gave us a breakdown of all the things we could do with that, was that you can create generational wealth through life insurance. And my only experience with life insurance prior to that was a police escort. We have a funeral, and then we have some chicken wings, some potato salad, and some collard greens, right? My man goes on to show us how to create a $2.1 million estate using this 401k and life insurance. And the 401k money can pay for the life insurance. And my head is blown. But what I realized was that there was rules to the game of money that everybody didn't know. And nobody in my community knew this. That's why I stayed in financial services, because we got to get this information out. Long story short, it changed my paradigm on how much life insurance people need, because I realized $15,000 is not going to pay the bills. Like, the first reason why you should have life insurance is especially if you're anything under 65 and you still got people in your household, you still got children in your household, you still got a wife you care about, vice versa, is to replace your income. If you're still working, I say, I guess 55 and younger, and you're still working and you still got a mortgage and you still got a family to take care of and all this kind of stuff, then that's the first reason why you need life insurance, to replace your income. Because unless you Biggie, Tupac, Prince, or Michael Jackson, or Elvis, I think he's in there too, you ain't making no money when you die. The rest of us better have some life insurance. Y'all remember Tupac kept putting out albums? years after he died. You know what I'm saying? Like this should go on an island somewhere, right? But the point I'm making is we're not taught to replace our income, and our life insurance on our job is not designed to replace our income. Sometimes you get a job that give you 10 times your income. Very seldom, and I run into one or twice out of the hundreds of people that I've sit down and counsel them on life insurance. I'm running to two of those individuals whose job afforded them 10 times their annual salary. But most jobs stop at about 50 grand. Because at that point, especially on workplace benefits, that can be pre-taxed. You can pay for your life insurance pre-tax. So if your job allows you to have pre-tax life insurance, go ahead and take advantage of it. You actually save some money paying for the life insurance, but don't have the illusion that that's your life insurance. Now, I've done workplace benefits. And guess what? It ain't your life insurance. It's the company's life insurance. They make this. If it was your life insurance, then tell me if you get to make the decisions on it. You might get to make decisions on how much you pay for it and all that kind of stuff, but you don't get to decide what company to go with. You don't get to decide what term, because there's actually an annual renewable term. It's not even like, it's not like a normal term policy or a normal whole life policy. Most of the time it's an annual renewable term. They do have some whole life, and generally that's the kind that, that's pre-tax. But the reality is you don't get to choose. That's a decision between HR and that salesman. I know. That's what I did. But the first reason why you need life insurance to replace your income. Second reason is probably if you're in business and you have a business partner and you want to make sure that that each other is taken care of. God forbid something happens to the other. That's called a buy-sell agreement. That's another reason to have life insurance. Perpetuate generational wealth. The third reason, hey, I want to leave something to my grandkids. You can do that in life insurance. That is a great product. And in most cases, you don't need your life insurance to go into trust, because life insurance is one of those is extremely liquid. Once somebody passes away, obviously, but it's extremely liquid in the sense that if something happens to you, it doesn't have to go through probate like your property and all that kind of stuff. And so you can pass that generation, you can pass it down to the first generation, down to the second generation. Obviously, you need to bury somebody. Obviously, you want to pay those final expenses. Those are also reasons. Now, the reason why I brought up the first reason being replacing your income, I'm not talking about replacing your income for a year. I'm talking about replacing your income for maybe who's the youngest in the house. I always ask that question. What if you have a 10-year in the house? Do you want to replace the income till that 10-year-old becomes 20? Get out the house. Education, paying off the mortgage. These are all reasons why you should have life insurance. Now, with that being said, would it be easier to take care of those things if you had more life insurance or less? You would agree? It would be easier if you had more, right? And so why would you buy a product which costs you more per thousand to get the same thing? That's why I say that buy term to invest the difference is probably the best system for most people. And I'm probably saying about 90% of people buy term and invest the difference would be a good deal for them. And there are some categories that those who wouldn't qualify for a term policy because of their health and those kind of things, they exist, right? I'm not saying they don't exist. There's some people who are real mature. They exist, right? So I'm not under the illusion that you should never have a cash value policy. That's not the statement I'm making. But I'm saying for most people, the most beneficial package for most people is a buy term and invest the difference package. And here's why I say that. Here's our scenario real quick. We got John and Mary on the left side here, and I'm going to use my little pen because I like to use my pen on this slide. I don't know why. But we got John and Mary on the left-hand side, and cash value has different names. They have whole life, universal and variable life. These are some of the names of these policies. But the way they work is you're paying for two things. You're paying for life insurance. You're paying for a savings component. Note what I say, a savings component. life insurance and a savings component. It's not a savings account. It is a cash value that builds in that policy. You're paying for both of them, but here's the main rule. Listen, you only get to take advantage of one at a time. You're paying for two things, but you only get to take advantage of one. So, why I say that? John and Mary, $75,000 each in life insurance. They're paying $130 a month. How this money works? Probably, I would say about 90% of that money goes to pay for life insurance, right? So most of that money is going to pay for the cost of life insurance. It's probably not 90%, probably maybe 70%. We'll say 90 because guess what? For 2 to 5 years, depending on your contract, no money goes in the savings. Check that out. Real talk. You're putting money into a cash value, but for 2 to 5 years, no money goes into the cash value. Unless you're overfunding that policy, which means you put more money into the policy so that you can force money into the cash value. But for 2 to 5 years, no money goes into the savings. But after, let's say after 15 years, you have, and I'm being generous at this amount, but at the 15 years, let's say you have 10,000 in the savings, and you have the $75,000 in life insurance. How this works? So let's say year 15, John passes away. Oh, so sorry for Mary. John passes away. Mary would get a check for $75,000. But how would you feel if I told you that the life insurance company gets to keep the $10,000? Now you're paying for both of them. You're paying for life insurance and savings. But if you take advantage of life insurance, if you get that $75,000 check, you lose the savings. You like that? That's good. That's good, ain't it? Not for you. Not for the average person. But that's how the game is played. So strike one is this. Strike one. If you take advantage of the life insurance, you lose the savings. LS stands for lose savings. Right? Strike one. Strike two is this. Let's say John don't die. But John needs the 10 grand. Let's say John is in construction. He got a dually truck, right? The transmission goes out. Oh, goodness. He's in construction. He got to have his truck on the road. He can't make no money. He calls his guy, hey, man, listen, I got my truck just went down, bro. I need you to hook me up. Hey, man, I got you, man. I'll find the transmission. I'll put it in. All it's going to cost you is 10 grand. John says, bet. I got 10 grand in this savings component. Let me call these guys up. He calls up the insurance company and say, hey, can y'all send me a check for 10 grand? They send him a check for 10 grand. But with that check, they also sent him a cancellation statement. He no longer has life insurance. Now, listen, I'm not telling you what I thought. I'm not telling you what somebody told me. I've seen the company cancel the life insurance when he took all the cash out. So if you take advantage of the cash, you lose the insurance. Strike two. Remember, you're paying for two things, but you only take advantage of one. And you're paying more for it. You're actually paying more for it than you should. Strike three. I ain't done yet. Almost, though. Strike three is this. Let's say, we know one is what? LS, lose savings. Oh, that's a bad S. Y'all just take my word for it. It's an S. Strike two. Ooh, that's a bad two. Let me try this. I normally do better than this, guys. I apologize. One, L, S. Take my time. There we go. Strike two. L-I, what's that stand for? Lose insurance. Yes. Strike three to me is the worst one. This is why I say it's the worst one, because you think you got a benefit when you actually are just being taken advantage of. So strike three, let's say John don't die. He don't take all the money out, but his boy said, listen, man, I found a transmission for you, and the guy, he doesn't want nothing for a transmission, man. He was just back there. He said, you could take the transmission. I'm just going to need the 5 grand so I can put it in for you. So John says, bet. He calls the insurance company and says, hey, send me a check for 5 grand. I don't need all the money. I just need half. They send him a check for 5 grand, and they send him a check for 5 grand, but they also send him a repayment schedule. You know why? Because he's going to have to pay that money back. He's going to have to put that money back with interest. Now, I know you heard what I said, and you've heard this concept before, But let me ask you a question. Whose money is it? Think about it now. Whose money is this? It's their money. They put it into the account. But when they ever need their money, they're going to have to borrow that money from the insurance company and pay the insurance company back interest. I'm not talking about, this money's not going, the interest is not going in your account. You paying back the loan. You paying back the principal. The interest goes to the insurance company. Now, on the low side, you might get 4%. On a high side, you might get 5%. 4% on the high side when you get in one of these kind of policies. But if you ever need your money back, they're going to charge you 8% to get your money. They're going to charge you 8% interest. Please tell me that makes sense. I'm going to give you my money, but if I ever need it, I'm going to borrow it back from you and pay you interest? That's, to me, is just diabolical. The insurance company is like, go ahead. Sure. You understand what I'm saying? They are actively taking advantage of us. And we think they're giving us a benefit. It's like the ATM fees to me, right? ATM fees. I put my money in the bank and you're going to charge me a fee to get my money, get access to my money. That's how the system is designed for most people. Not only this, I ain't done. I'm going to go ahead and kill the rest of this. Not only that, but then your face value of your policy is going to decrease by the amount on the loan. So instead of you having $75,000 in life insurance, you're going to have $70,000 until you pay it back. Please tell me that's a good deal to you? Because if it is, stay the way you at. You good. You good. I can't teach you nothing. Right? But if you want the possibility of getting better, here's what we do. Buy term invested different. We take John and Mary, same couple, and we bring them over to our side and we give them more than three times the coverage for almost half the money. So 250, and this is so typical. These are just not numbers we threw up here. This is typical. Now, so what's the catch? There is no catch, though. We're not going to lie to you about some fictional savings. What we will do is give you the most life insurance we can give you for the lowest cost possible. Because we understand this thing called the principle of decreasing the responsibility. As the younger you are, the more financial responsibility you have, the less cash you have. That's why you need to replace more of your income. The older you get, the more assets you should have accumulated by this point, and so the less life insurance you should have. That's why a term is decent for you. Although terms of Primerica are age 95. So if we got you by 70, we can keep you to age 95, right? But here's back to the story. So John and Mary, we got them $250,000 each in life insurance, paying $80 a month. What's the catch? No catch. Just not going to lie to you about fictional savings. What we will do is give you access to the market. It's going to give you access to some of the best companies in the game. I'm not going to go through all of them, but y'all have heard of all these companies. You've heard of Fidelity. You've heard of Invesco. You've heard of Lincoln. You've heard of Franklin Templeton. You've heard of these companies. And these companies are the best, like I said, best companies in the game when it comes to financial services. But with us, you can get into the game for less than if you had to go outside of us, because they give us like special treatment. They give our clients special treatment, right? So here's the thing: buy term and invest the difference. We're gonna give you a high value, low cost term life insurance product, and then we're gonna give you access to the market. Now, let's say same scenario, 15 years. Let's say 15 years we got 50,000 in the cash, right? 50,000 in cash. At 20 years, I almost guarantee you we have about 50,000. So let's say 20 years we got 50,000 cash, and we have the $250,000. If John passes away, Mary gets it all. Mary gets all the money, right? She gets the life insurance and she gets the savings. Let's say he doesn't pass away and he needs to get money out of his life insurance. Guess what? Not his life insurance. I'm sorry. Doesn't pass away. He needs to get money out of his mutual fund. Guess what? It doesn't affect his life insurance. He still have all this life insurance, right? Let's say John doesn't die. He doesn't take all the money out of the life insurance. He just takes some out. It doesn't affect his life insurance. all this money is his and is vested from day one. It's not like you got to wait 2 to 5 years over here. All this money is yours. And if you need more than $250,000, we can find a price that we have a price that is going to be comparable to what you can afford. Especially, listen to me. Holler at me if you're younger than you're 30 years old and you got a family. If you're 25 years to the 40 years old, 25 to 40 years old, and you got a family, holler at me. If you're interested in getting $1 million life insurance policy, holler at me. We can find something that's going to be affordable for you, that's going to take care of you, that's going to take care of you. If you got to just purchase a home, a mortgage, and you want to get mortgage insurance, holler at your boy. We can find something that's going to be affordable for you, and it's going to make sense. And we can put you in a position where you can have a savings account that actually will grow with the market. Right? Last thing I'm going to communicate. I'm done here. Last thing I'm going to communicate is talking about protection. So protection, here's what I mean by protection. Not talking about that, but protection of your money. Like when you are accumulating your wealth, you can be a little bit aggressive because you kind of have to be aggressive if you're trying to accumulate wealth, right? You got to take risks to some degree to accumulate risk. Once you have accumulated a certain amount of wealth, you want to put protections in place. And that's the last part I want to talk about is what those protections. I can't really go into details because I can't make it really an advertisement, but I can educate you, right? There are products out there, you can look them up, called variable annuities. And these products can put protections in place that most investments can't even touch. Like, and I'm talking about maybe a 10, 15, even 20% buffer. And that's important the more mature you get, because the older you get. So, our stock market is unprecedented at this point. We had literally 10 years of growth from 2010 to 2020, and then COVID hit, and then kind of a little shaky, and then we kind of back kind of riding, kind of back in a high for the most part, but a correction is due. And a lot of analysts are talking about the AI bubble. A lot of analysts also talking about the credit bubble that we're riding right now. What I mean by that, what I'm not going to go into details on the credit bubble, but why I'm bringing that up. The reason why I'm bringing that up is that when you get more mature, you have less time to recover from a correction than somebody who's younger. If somebody's 30 years old and the market does a big hiccup, that person can recover. Y'all remember 2006, 2008, 2010, by 2014, you got all your money back in double, right? That's generally how it works. But when you're older, you don't have, you might need access to your money before. 2006 to 2014 is 8 years. You might need your money, access to your money before it recovers. You don't have that time. Probably don't have the patience, right, to wait. And so those individuals, if you're 59 and a half older, or you're 59 and a half older, you are that group of individuals who need protection around your money, especially in our current market. And so you want to talk to somebody about what does a variable annuity do? How can it help me? In some cases, in my opinion, variable annuities are magical. The way they can protect your money, where they can grow your money, the way the contracts that these insurance companies, the contracts that they're able to put together for you and your family to create generational wealth. They're magical, but you need to find somebody who's qualified to communicate that to you. And if I don't know the answer, I go straight to the wholesaler. They don't even mind getting on the line with me, with my clients. So I'm not selling a variable annuity, but I want you to make you aware of there are products out there that are just plain magic. And they're really, really good, low fees. But for our community, for generally the African American community, we tend to be on the back end when it comes to a product or service that can help most people. We tend to be on the back end of it. We get it last. I want to make sure you guys know that there are products out there that you can get in on the front end and you can get them first. You can have as little as 25,000 into invest in that. Again, that's a Primerica deal. That's not, you can't get that everywhere else, but you can get that from Primerica. So I just want to communicate some things with you guys. I hope this made sense to you, and I hope it blesses you. And I'm going to put more out. Take care.